box and also raising your hand. That'll allow us to talk with you in person. We do have our legal ease to get taken care of, and Mark will walk you through that real quickly. Mark?
All right. Well, greetings, everybody. Welcome to our April 5th, 2022 bull session. Again, we're going to cover some of the stuff Ken was just talking about, along with Circadian Coffee, which I joked about during, was that the last roundtable, Ken? We were talking about, we were talking about Stonehenge and moving the big stones around with boulders.
For daylight time, right.
Daylight savings time, and they won't be needing to do that anymore. So we're going to kick around a few of those things and others. But first of all, as Ken was saying, here's the legal paperwork. No investment recommendation is intended. This is entirely about education, specifically the demonstration of philosophies, methods, and techniques that are 80 years in the making with the modern investment club movement. So the stuff that you see here will be our interpretation, our being manifest investing, Ken, myself, and basically this community of how we look at those lessons and how we deploy those lessons. So they are opinions. Please do your own homework before actually making an investment decision. And pretty good track record in this community, but still you want to do your homework and do it carefully. If we own something, we'll try to disclose it. And again, our roundtable is usually the last Tuesday of every month. If you want to be added to a reminder list about that webcast, which has been going for 12 years now, with a pretty good track record, we're going to talk a little bit about it here, but please send an email to nkavula1@comcast.net if you want to be added to that reminder list. And then if you have any follow-up questions for either Ken or myself, our two emails are at the bottom of the page there. All right, Ken, I thought we'd just start with that standard starting point here, just a quick reminder that this is kind of our measure of the total stock market. The value line arithmetic index are the prices. It's basically the index of all the companies in the black or the green book at the library for the value line standard edition. So those green bars are a representation of the total stock market. And you can see they've kind of plateaued and they're kind of heading for that blue line again. The blue line is just simply exponential computer-generated trend line. And with a constant, basically a constant growth rate, something like 8 to 10%. So the green bars are approaching the blue line again, and that's a normal thing. The red dots and the trend of those red dots would basically be a snapshot, quarter by quarter, going back to the start of this century of what would a stock selection guide prepared by Value Line look like for all of these companies, and basically all kind of put into one single recipe to kick out one point. That would be the average of all the companies. That's what the red dots are. So basically think of it that way, that you're looking at the average return forecasts according to Value Line going back 20 years. And they obviously fluctuate with the prices. They're kind of in a normal place right now, somewhere in that 10% projected return position. Any highlights you want to catch here, Ken?
Well, that 10% number, that 9.5 to 10.5% number, that stayed pretty consistent for a long, long time, hasn't it, Mark? Even well before the 1999 beginning of this chart. So it's a number that we like to use to measure the market as an average number. You'll hear many times us talk about the average return of a stock being around 10%. And that's where, in fact, that 15% idea from better investing comes from. It's Mr. Nicholson suggesting that a stock club could beat the market by 5 points. Simple arithmetic. The market's doing about 10, and he thinks we can beat it by 5. There's your 15.
Absolutely. One of these days I'll have to go back and actually figure out how many actually land between 8 and 12. That'd be an interesting factoid to have. And then anything below or above that range is a little bit unusual. All right. Okay, let's take just a quick stop in on the groundhog. We don't need to do this every week, but hey, it's kind of fun. We have a new sheriff in town. It's the old sheriff. unseating the incumbent, Sean Mace. So Curtis Sears, who was in first place, is now back in first place, and he's a former champion. And you can see there's a number of very familiar names up at the top. George Mackey's up there again this year. Warren Buffett continues to lead the celebrity groundhogs. A whole bunch of clubs. In fact, there is a huge number of clubs between 40 and 60 that are just kind of percolating down there. My name is not quite on here yet. Kind of down there with me, but I'm getting there until Len Douglas tells me that the NASDAQ is down 3% today, which will not be helpful to me at all. And
I'm glad to see the monkey climbing down the chart, Mark. He's down to 27 now. Every time I look at this, he's down 2 or 3 more. So that's a good feeling. I would not like to see the monkey end up in the top 50 even. So I'm hoping he'll continue his downward swoon.
yeah, isn't that
It's
referred
really,
to as Schadenfreude when you want something bad to happen to?
yeah, you're celebrating negative things. Schadenfreude, yeah. Kurt Kowitz up there at 25 deserves a pat on the back. Although Kurt's such a low-key guy, he probably would just go, "Oh, that's nice," and continue. You know.
Well, he's been in the contest for more than 10 years, and he's checking in at a 1 or 2% advantage to the market. And again, he's infamous for spending maybe 15, 30 seconds a year doing this. So it says a lot about the ability of the system of picking the best companies at the best prices, and it works for him. I see Nikki's made the list on here. I hadn't noticed that. Nikki Patrica down towards the bottom there. Anyhow, in terms of gauging what's happening in the market, our average return for everybody involved is right there at around -4%. So we can do better. I think we will do better. 20% of the people are beating the market. Kathy Wood has zoomed up the list, although I think that's probably changing today based on what Len was advising us. So again, we don't want to spend too much time on that. Here's a quick update on our best small companies. The situation has not dramatically improved. It's a little slightly worse, in fact. We're having fairly weak performance. Thank goodness for Pachira and Car Gurus and Ensign. They're carrying a lot of weight up there. We did add, as of last week, First Foundation. Decided to go with the audience so that if you're wrong, I can say I told you so. And well, I don't even know how to word that, Ken, but you know what I mean. No Schadenfreude when it comes here. But I also wanted to throw on here, I can show you where we checked the shaded ones are the highlighted ones at the bottom. Green Tree Hospitality and eHealth have been taken out of the traditional portfolio. That continues chugging untouched until next Halloween. But we replaced eHealth with Pachira Biosciences, and Green Tree we replaced with First Foundation. And just for kicks, I added at the bottom just to show that eHealth, since the time we sold it at approximately $30, it's continued to go south. So, Ken, I think that's a pretty good demonstration of the old rule of 5 kicking in as far as our selling discipline is concerned.
Absolutely. It was, and we don't really have a concrete reason why it's moving so dramatically in this direction either. It's there's a lot of conjecture and a lot of things too many things to point at. They can't all be operating negatively at the same time. So it's an interesting company still, but I'm glad it's off the list. Green Tree Hospitality, of course, is caught up in the Chinese clamp down on profit. It seems the clamp down on capitalism, if you will. I'm not happy that our traditional portfolio is now mimicking the Russell 2000. We'd like it to outpace the Russell 2000, and we'd certainly like to see it outpace the general market. So it's, I hope this won't be the first year in many that we've underperformed the market. And if so, Mark, maybe the visibility of what we've been doing is not playing to our strengths. Maybe we spent too much time trying to come up with this list, and maybe the shorter amount of time maybe played to helping us out in choosing companies that were obviously at the top, didn't need a lot of extra study and a lot of extra digging to come up with a possibility.
Well,
That's a big red relative return list right now.
yeah. Well, that's a pretty good segue, and people are going to think we planned that. Yeah, you can overthink this stuff every once in a while, and I think that may be the case here. I want to pull Sharp's compliance into the picture here. I still have a lot of faith in this company as a long-term investment. I'm not so sure what the next holds, but let's take a look at the company and what's kind of been going on. And I think I can pinpoint the mistake I may have made with Sharp's compliance. This is actually one of those companies that comes to us from the Tulane Stocks Under Rocks thing that goes on there with the student endowment at Tulane University, and that's where we first became familiar with this company. They make the stuff that's up here on the upper right, the disposable systems for medical waste and biohazards and that kind of stuff. And they basically benefited from the onset of COVID with the careful disposal of medical materials and all that kind of stuff. And we basically keep in mind that we're basically looking at that company as it's cresting here. And another company that comes to mind that I think we're going to take a much closer look at is Pfizer, and how they have crested in a much similar way. And the problem with a company like Sharp's Compliance is they just recently came positive. And Ken, you go ahead and jump in with your warnings. Anytime that a company this delicate and this new and this small has this type of a picture where the earnings are possibly headed for back sub-zero, it drives investors crazy. And that's kind of what we're looking at right now. We're looking at a downdraft in expectations for the year-end 2022. So it could be in trouble from that respect, but longer term, I mean, I'm looking at 12% growth, 10% net margins, which makes a lot of sense based on what they're doing and what their track record looks like. And what it basically adds up to is two numbers that are fairly consistent with each other. So projected returns that are still okay, but probably we may have been misled by that bump of enthusiasm. It shows up in the stock price here also. And I thought catching it back down here at 8 was going to be an absolute brilliant move. It has worked out.
Let's remind the audience, Mark, that Manifest has a slightly different way of looking at growth. Not only do we look at historical growth, which would be the 2021 fiscal year backwards, but we look at the analyst expectations for the next 2 or 3 years whenever they're available, and we plot them, and we make that part of the trend line that we're then going to measure. So that 2022 projection number is really kind of important if it's at the bottom of a slide downward like that. If it ends up a little bit higher, then that moves that whole line upward on the graph, and it significantly impacts the trend line then. So I'm with you, Mark, that if the analysts have gone from being too optimistic to too conservative, and we see that in a lot of cases, then maybe there's a happy medium in there where those last 3 data points are actually going to be a little bit north of where they are right now, and that'll give us a more robust trend line, which will then copy over to the growth forecasts, not necessarily on the earnings line, because we don't start with earnings, but the same thing's going to be true, just to a lesser extent, on the sales line. We had that bump up in sales there as well. So if we could conceivably say to ourselves, well, value line has gone down to 12, but maybe it should have stayed at 13 or 14. I'm curious, Mark. Do we know why Value Line has changed its idea about net profit as much as it has?
Well, that's basically numbers. I should have made this my study up here. So just kind of imagine that it says my study right here also. I, I,
Okay,
I just
so
I just selected that to go back and be more consistent with the previous profit margins. Without that, basically taking the bump out as a
okay,
outlier and trying to ignore it a
all
little
right,
bit. Yeah.
okay.
So I mean, it's an interesting company. They're obviously embedded. They're pretty good at what they do. I mean, interestingly enough, their liabilities have gone down. Their cash has gone up. That's kind of cool. But I guess what we're saying, and then we'll move on, is if this dips below zero, we're going to get killed. That's what it comes down to. If that earnings currently hovering above zero dips below zero, people will lose their minds. Tax related selling will commence, and it won't be a pretty picture for us. So
Yeah,
maybe
I do like the fact, Mark, that the prove number is kind of validating and reinforcing the par number.
absolutely.
They're within a point or so of each other, and that is always good when you see that happening. And I do like the fact that they're a little bit flush with cash. You can make a great story for Sharp's compliance with all of the shots that are being given and all the testing that's being given, and then asking yourself, what did they do with all that medical waste? Sharps has to get a certain portion of it as part of their business. I'm not sure that all that testing and inoculation and all that kind of stuff is finished yet. So I guess you just kind of watch very carefully, and you either watch it deteriorate below zero, like one side of the coin, or you watch it come in maybe at your prediction or even a little bit higher than the prediction right now.
Yeah. And one last somewhat related comment, talking about the situation over with my dentist. And they basically went through a period of that entire period of shutdown where they had to cut shifts, and they had to be very careful for a while. They were completely shut down for a while. What they are witnessing is a return to elective procedures, some of them really elective, um, present company included. And I just think that the return to some of that type of stuff is also bodes pretty well for companies like this, but we'll see. Time will tell.
It's interesting, Mark, because my dentist has gone back to 2 nights a week on top of their 5 days during the week. So business has obviously picked up. It's only a little one dentist practice, but he's gone back to working 7 different shifts now. So
Yeah, my guy added a second dentist, and so basically doubled the capacity. But the real downside of all that is a lot of the doctors and nurses are exhausted. So
yeah.
we have that to look forward to too. All right, let's go ahead and switch gears to a theme that we touched on last week. Thought we would just extend it a little bit. Love this tweet. Can talk about tweets in a minute too, but um, we talked about this last week in the context of Disney and people saying, "Well, anybody can do it, but nobody does." That clean, pristine theme park, which Matt Spielman actually let us know is completely back. Every single facility is back up and spinning now, so they're back in full Zoom mode. But I got to tell you, I was guilty of. I'll do the first confession here, and then you can take one, Ken. I mean, I can remember standing in the office at Better Investing probably 20 years ago, and basically convincing myself that how in the world is Google ever going to make any money? I mean, great search engine. I absolutely convinced myself that there's no way these guys are ever going to amount to anything. Um, there you go. There's my forecasting skill for you. I think we were talking about this in the context of NVIDIA. Did Natalie do her presentation?
Yes, she did. It was really well received. There's just so many things that I didn't realize NVIDIA was working hard to become a major player in, and it's so far away from where I thought the majority of their chips were dealing. They're still they're still top of the heap in a lot of these very specialized kind of chips that do gaming and that are three-dimensional, and but they're just moving into so many different areas that I'm looking at this list and I'm saying to myself, I own 5 of the 7 on the list, but I wasn't an early adapter of any of the 5. I wish that that's not true. One of the 5 I was an early adapter on through my father-in-law, who left his daughter, my wife, 5 shares of Apple stock, the original Apple stock. But that certainly wasn't a wonderful up straight money-making proposition for a lot of years.
Mm-hmm.
Apple certainly, we held on to it for as much sentimental reasons as anything else, and didn't really go all in on Apple until 2008, when you just couldn't ignore the sales growth going on in the product line that they had, and you couldn't match that with the price that they were selling for during the Great Recession. So I still don't own Tesla. I just can't value a car company with that kind of valuation.
But they're not
Uh,
just a
but
car
but
company.
but they're not just a car company, right? And I don't own McDonald's, but Starbucks is as close to a restaurant as I ever want to get again. I've just been burned by an awful lot of restaurants over the years, and Starbucks has been pretty good to me up until recently, at least. So I can't warm up to McDonald's, but that I never really thought that it was a bad company, and maybe in fact it's one of the best of breed, but I just can't warm up to McDonald's.
I think.
I thought Facebook was a complete washout for a long time.
Mm-hmm.
You used to tell me Wendy wanted to be able to say she owned some of the first shares of
She
Facebook,
did.
and I know she did, but I used to think to myself, well, I'm not sure that's something I want to be known for, you know. But even today, with the silliness that's gone on with that stock, I think it's still showing its strength. And if you're a long time holder of Facebook, you've still made a really good return on it. So
Yeah, what's not to like?
yeah,
Um,
what's not to like about Facebook, right?
who knows? That could be in the Elon Musk crosshairs next. Yeah,
Yeah.
I would echo a lot of those thoughts. Google is a machine now. Apple, you could literally watch our community turn on the spigot and buy Apple back in 2008, and then a few years later there was another period of accumulation. But it was just fascinating to watch that as it unfolded. Tesla's not just a car company; they actually are more of an energy company. That's what drives most people crazy when it comes to that. And anyhow, interesting stuff. And this is why you don't want to sell any of this stuff too short. This guy is obviously eccentric and a genius, and we've talked about him a lot in some of our past bull sessions, going back to Hugh McManus's dissertations on the fact that these guys make shingles and they drill holes from Las Vegas to Los Angeles and all kinds of stuff's going on there. Well, now he's involved with Twitter. And just the fact that he reached in and bought 10% of the company here a few days ago.
9%, Mark.
Yeah, well, it'll be 10 by this afternoon. Especially if Len is right about prices going down, Musk will be all over that. Because I believe he's probably after 51% ultimately. But it's kind of interesting. The proof is still not completely unreasonable. So that's a company that, again, I don't know. I use Twitter a little bit. It's not a major part of what I do, but it's been quite prominent in the media and stuff. So I don't know. What do you think he wants to do with Twitter?
Mark, I think that Elon Musk doesn't always know what he wants to do with anything that he gets interested in. I think he's extremely creative. I think he's extremely impulsive. And I think he's extremely, extremely, extremely bright. And those are the kind of things you see in very, very bright children, that that they're acquisitive, they're collectors. They will get interested in something and take it, 26 steps further than any other child in the room would take it. And he probably drove his teachers stark raving mad. I think he does enjoy listening to some of the talking heads on television. One of my least favorite talking heads, and I'll name her by name, is Sarah Eisen. I feel that she's I think she's a little bit too aggressive when it comes to her interviewing style, as she's always interrupting people. And she was positively apoplectic yesterday trying to describe what Musk had done with Twitter and trying to figure out what he was, where he was going. And I think he kind of enjoys watching people just get speechless when he does something completely out of the ordinary. He certainly has the resources to do this. I mean, I don't think this probably caused him any major headaches in the bankroll.
Oh,
What's he going to do with it? I think your guess is as good as mine. And again, I'm not sure that he knows himself yet.
Well, a couple things there. Sarah Eisen is no Maria Bartiromo. And I guess the way I would encapsulate the entire discussion is I have no idea either, except I watched this guy land a rocket on a barge. I mean, that just did me in. Anything is possible, and it's definitely going to be worth watching. All right, speaking of Musk.
We'd have a hard time doing that by hand, wouldn't we? Just placing it on the barge and making it stand up.
I can't even center my car in the driveway, and I don't drink. So much, anyhow. Although I may have to stay.
I'm going to unmute Herb Lemko, who has his hand up. Hold on a second.
Okay.
Herb, there you go, Herb. Go on.
He probably wants this one.
I was just letting you know that I just read where he was put on the board of directors for Twitter, but he couldn't own more than 15%, and I'm not sure what that rule is. So I'm not sure what's going on there that way.
That means he needs two friends. Are you going to go in with him?
Yeah, right. So it's just a point. Yeah, everybody was giddy about Twitter and about Elon Musk yesterday on the news.
Yeah, and it's probably the typical overreaction. But I will say one thing, and I'm going to try to avoid being political. I do see this as a potential tipping point to restore the sanity to the American journalism system. I think it's that big, because it's wrecked right now. So we can be hopeful, I guess. All right, thanks, Herb. All right, we'll just let that comment hang out there for a minute. Here's a question we received about Tesla. They were curious about the quality rating of Tesla, because it is held in quite high regard, and it's still a fairly young company. They did qualify for inclusion in the S&P 500, and this person actually wondered if we knew Nick Strategos, and boy, did we know Nick. And damn if we don't miss him. He's a former Groundhog champion, but more than that, he was in constant touch with us here at Manifest Investing, and just a real joy and a wealth of stuff. So yeah, we did know Nick well, and we miss him. So just a tip in the direction of Pittsburgh. And that is him with the Stanley Cup, by the way. When it comes down to the Tesla quality rating, again, there are 4 components of quality. And the place where Tesla's going to run into the challenge is going to be with the fact that they have a fairly limited track record. And the track record that they do have is fairly turbulent. Obviously, it's a very strong growing company. The 4 components of quality max out at a 25 per column. So they're actually pretty profitable right now and rapid growing. So that's not where the deficit in quality comes from. It actually comes from a little bit of financial strength, but I do notice the Value Line has upgraded them to a B++, so this number is probably going to raise a little bit. But here's the real source of the heartburn as far as this company from a quality standpoint. I don't know what tomorrow holds, and they certainly are on a nice trajectory, but this has been pretty bumpy, and that's why this number is basically holding down their quality rating. Would you concur with that, Ken?
Absolutely, Mark. That there's four equal pillars, and the company has to have four good numbers to end up with an 80 or better quality. And when EPS stability moves when the EPS graph moves all over the paper like a roller coaster, and where it takes these huge downdrafts and these huge updrafts, you can't call it stable by any means. And I think until the company does end up with a little bit more stability in its earnings, it's going to be extremely difficult to put a value on it and to decide when it is a good consistent buy and when it's not a buy. Right now, I still think that people are buying on the story. They're buying on a little bit of speculation. They're buying on the CEO perhaps. And there's nothing wrong with that. There's room in your portfolio for stocks like that if you have a reasonably mature portfolio. But it's certainly not a classic growth stock, at least not at the moment.
At least not yet, yeah. And if you are curious, if you want to do a deeper dive and think about taking this on as one of your non-core, if you go back to the Hugh McManus discussion from about 18 months ago, where we talked about Tesla, and we first were laying out how the projected return on value, the proved calculation, might actually be helpful. I think I would spend some time with that and just, put that into context also. And that actually brought in this topic into discussion also, a number of questions, including when we signed off last week about the splits at places like Tesla and Amazon, and there's several others that have announced them, including GameStop, which I think is kind of an interesting one. But is that sugarcoating it enough?
That's an interesting choice of words, Mark. Interesting.
Well, I'll tell you a little sidebar story here. When I heard it and I watched it go up 20% in a few minutes after they made that announcement, I said to my friend Sean, if I could find a way to short that thing, I would, because it's going down tomorrow, and it's down 40% from where it peaked up to after that stock split announcement. And again, I'm not trying to be too detrimental or disparaging of stock splits, but they really don't change the value of the company to an investor at all. It creates a little bit of demand on the retail side. Sometimes it juices up what some institutions will do, but the stock split of and by itself really doesn't do that much. That's why the piece of pizza is there. If you slice it in 4 slices, and you decide to make it in 8 slices, you don't get more pizza. You get maybe more people eating. That's not all bad either, but I don't know. Any way you want to capture that, Ken? What's your outlook on
that? I don't want to capture it any better than you've done already, except to say that those of you that are still confused about stock splits or still trying to maintain the idea that it adds value, I would urge you to go to the internet and do a little bit of searching for some articles about stock splits. There are so many articles out there, and they come at the question from so many different ways, and they all come to basically the same conclusion, that there might be a little bit of a glow attached to the stock as it splits, but that quickly dissipates, and there's nothing else measurable that you can find in these stocks, whether they're splitting 2 for 1 or 10 for 1 or 40 for 1. So go and do some reading, and maybe do some academic reading. There's some pretty high class names that have written articles about this, people that hold chairs at pretty well respected schools of business throughout the country. So do some serious reading. Take a little bit of time. If that's really something that you're banking on, you should know more about it than just a vague feeling of I want to do it. If that's all that's motivating you, then that's probably not enough.
Well, I'll tell you, I get the question quite often, and I'll usually give the flippant answer. No, I don't get flippant very often, do I, Ken? But flippant?
not as often as I do. So.
Okay. Well, I say hate them. And give you a little more background on that. We keep a database of 2,600 stocks currently at Manifest Investing. And anytime they do one of these, it messes up anything in the database that is per share. And some of those are manual fields that have to be corrected. So the fact that we haven't had stock splits for the last 5 or 7 years, I've been on vacation. And now this is basically saying, Mark, you're no longer on vacation when it comes to stock splits. So I'm going to say it again. I hate them because they don't really do that much. All right. In line with that thinking, similar thinking, a little different. This is from today's Morning Brew. Howard Schultz is back, and he announced that they're not going to do their 20 billion stock buyback program over the next 3 years. Why does that matter? Well, as Len was telling us, I don't know how much Starbucks is down. We can maybe get a reading from Len. We had a question from a couple of subscribers that were basically asking about the negative book value. And here it's showing us share equity at Starbucks. And they basically have taken on a bunch of long-term debt. That's right here. So they're basically using long-term debt, and it's not even that great a debt. It's 4.5%, 5% debt to buy back shares. And Schultz arrives on his second day on the job, says we're not doing that. That apparently has sent the stock into a tizzy today. But that's what you're looking at here. You're basically looking at a situation where now their total debt is actually dwarfing the actual stock value of the company, or their assets. When think of it that way, assets minus liabilities is shareholder equity. So, it's just, it's a simple situation of they're basically doing with the company what is shown on the upper left. They're leveraging this sucker up and drinking a double shot espresso, and that's fine while things are good. It just means that the company is more vulnerable, and as a shareholder, you're basically hanging out there a little bit more. Notice the book value per share numbers here. Anything you want to add to that, Ken, or how do you view this situation?
I'm reevaluating Starbucks. It is one of my 18 or 19 holdings in my main portfolio. I've held it for a reasonable amount of time, maybe 7, 8, 9 years. And I'm reevaluating right now whether I want to continue to hold it. I understood the negative book value. I understood the leverage that the company was using. I'm not sure. I guess I have more concerns, Mark, with some of the outside the U.S. Positions and movement, and I have a real thing right now for Starbucks and China. I just think that they're precarious in a country where tomorrow the government can say we're closing all the Starbucks. It bothers me because Chinese Starbucks makes up a pretty decent piece of the pie for this company.
And I should
So
know
I'm
that percentage.
wondering where he's pointed when it comes to foreign. It's not acquisition, but foreign openings of this ubiquitous company. It's not the Starbucks I bought. Let's put it that way.
Mm-hmm. There's a couple things that do come to mind. I think this is probably an excellent example of using Prove to double check your stock selection guide results, because again, that's going to bring fully into the picture the total liability situation in the denominator. And it is a fascinating story. I think they are hanging out there a little bit. But using that to avoid some of the other irregularities that you run into with some of the other financial calculations. So,
yeah, I'm. We're getting comments in the back room here about the labor problems and everything, and unions don't bother me nearly as much as they evidently bother some of the people that are listening to the broadcast today. I think unions are a natural outgrowth of the kind of work that you ask people to do. I never in a million years would have thought that I'd be a union member when I went into teaching. And yet it was society and the government that forced the unionization of education. I don't know if it's all been for the best, but I know that it at least gave most teachers a livable wage where they could operate on working a single job over 1 year and maybe even get married and have a couple of kids. I think the same thing's true about some of these places that we've traditionally operated on a shoestring, paid the people virtually nothing, not worried about what they could do with their off time or with their lives. And now I think it's coming back to some of these companies where they're going to have to think long and hard about whether they can run the same business model. Amazon just unionized its first warehouse on Staten Island. Starbucks is voting to unionize some of its, quite a few of its, what do you call them? Coffee houses, I guess, distribution centers,
Yeah.
So I'm not afraid of unionization, and I think any good management will be able to deal with unionization. And I don't think it's coming just for Starbucks. I don't think they have to worry that they're going to be the only fast food kind of a situation that's unionized. I see it coming for a number of these large conglomerates that are run not only by the company but by franchisees as well.
Yeah, I think when you talk to some of the analysts that cover this type of stuff, they will talk about how the unionization can actually provide some stability of expectations for operating costs, and that is part of the component. In fact, I have on my list to listen to. I listen to Freakonomics. In fact, we're going to talk about popular webcasts at a future bull session. Freakonomics has one on the decline and potential for unions that I want to listen to, especially on the heels of Staten Island and Amazon. So should be some interesting listening, and we'll see if there's anything there that can be shared or extrapolated with, from an investment standpoint.
Mark, Christine wants to be clear on your position. So are you saying that you feel that the suspension of the buyback is actually hurting the stock at this time?
Oh, Len Douglas might give us an update if you watch for his hand, Ken. I think
Starbucks right now is down 4%.
Down 4%. Okay. Yeah, they're definitely, the talking heads are definitely blaming Schultz for sure. I don't know whether that's true or not, but yeah, I think he probably did hit that kind of cold without enough explanation, is my personal opinion. Because he basically walked in and said, we're not doing this. And noticed that they have done that for a number of years. Notice the number of shares and the steady decrease in number of shares. That's a subject for another day as to whether or not that was all good stuff. But yeah, I do think it's probably been a bit disruptive.
Well, the other shoe might be reduction or suspension of the dividend too, Mark.
Yeah, absolutely. So it'll be interesting to watch. Okay, let's go ahead and switch gears. The Wow Lady's back. Just wanted to remind everybody that the roundtable, we had a little bit of a cyber celebration at the most recent roundtable, but we are back beating the Wilshire 5000 by that magic number Ken mentioned earlier when we were talking Stonehenge about beating the market by 5 percentage points, 5.1. And to put it really in context, and that's where the Wow Lady comes in, I ran a really quick cursory analysis, so don't anybody beat me up if you can prove that it was 31 funds and not 30. Quick Morningstar analysis of the last approximately 10 years, and it looks like there's only about 30 funds out of the 24,000 that are doing better than 17.3. So that's a pretty good number, I think. So the Wow Lady is back. All right, and here's an Easter egg that Ken and I wanted to share with you guys. This is from Cy Lynch's presentation of Littelfuse at the last roundtable. You can actually go back and listen to that. These guys are a company out of Chicago that we first became aware of, I personally became aware of, with Ariel Capital Management and a presentation they made to the Chicago chapter in the late 1990s, actually on Easter weekend, hence the Easter eggs and the Bugs Bunny there. It was actually on Easter weekend. John Rogers and Melody Hobson were there, and they shared that they, at that time, and I think for most of the time since then, have had Littelfuse in their portfolio. They make all the little stuff, the fuses in your car and all the connecting stuff and sensors. And you see all those little components down on the lower right. That's what they do. And the company's been fairly steady. They're obviously going to be a little bit economic sensitive to disruptions in the automotive environment or whatever, but pretty up straight and parallel for an industrial type company. Very consistent profitability. And you're looking at really nice, decent double-digit returns. So, Ken, did you see Littelfuse as an Easter egg also?
Not only that, Mark, but it went right into our study at the Wolves Investment Club, my private investment club. We have been really deep into trying to find a company that had some gravitas and some history and maybe some other products besides working with charging stations. We want to have that as a piece of our portfolio. We really believe that that's something that we could sit on long term. And we have a pretty decent list of companies that are involved in charging stations that we're studying, but somehow Littelfuse had avoided our research. And when Cy brought it to us and suggested that they weren't necessarily making the stations, but making the parts to make the stations, that just really resonated with me. That's the old sell the picks and shovels to the gold miners, don't go out and mine the gold yourself. So I appreciated that model, and so we put Littelfuse right into the study list, and we're going to take a serious look at it at our next meeting and perhaps even take a position in it.
You know, we'll look to see how that turns out. This one is kind of tugging at my heartstrings, and it's got quite a track record, and it's leveraged in some really neat places to be right now.
I'll tell you the other company, Mark, that we're looking into very carefully, and that's the company that we had dealt with quite a bit at the round table and then kind of let it sit for a while, and that's AeroVironment.
Sure.
The ticker is AVAV, and they were 10 years ago, when we were talking about the company at the round table, they were just getting into drones, and they were dealing with charge stations. So we have a subcommittee working on that to see if their charge station industry ever went anywhere. And we know that AVAV is making the majority of the drones that we're now sending to the Ukraine. So another company that out of the past that suddenly has become extremely relevant. They have a lot of the components in this tank killer drone. A lot of that particular drone is coming directly from AVAV using some of their patents. So very interesting, as well as Littelfuse. The two of them together, we really have, we're kind of hot on both of them right now.
Well, cool. I'll have to take a closer look at AVAV. That's another one that Hugh McManus had studied fairly carefully. All right, we're coming up on when we want to shut down here today, but I did think I actually received as much or more favorable feedback on this tiny little demonstration last week, and people wanted me to clarify a little bit, so I thought I would go back and just kind of take a step back and clarify what we're doing here. And it's what we refer to as the janky utility reserve. And what we're really trying to do here is just put together a portfolio which pays the electric bills. And about a year ago, back on May 24th, we picked these 5 stocks that are shown here. And those were picked with conventional studies. These are all pretty good utilities. And the purchase prices are here. Their price today is here, so you can see that all 5 of them have had fairly decent appreciation since then. You can see the actual numbers. We invested approximately $45,000 into these 5 stocks. The actual numbers for each one are right here. That the original cash flows for the 5 utilities are right here. And then we put $330 on the side just to have a balance in our checkbook. Well, you can see what those values have grown to over the last year. And the value in the checkbook has actually increased. And we have paid 11 electric bills along the way. So this is really kind of a neat demonstration of, and it is precisely the way that Ken got his dad back interested in investing, a very similar type approach of creating this type of stream from the dividends. If you want more details as to what the transactions have been, including the transactions since last week's roundtable, there you go. You can see that the 5 utilities up at the top are right there. There are the dividend payments, and the really important thing, the thing that we're trying to demonstrate, is that we can keep this the number in the bank account positive so that a direct check can be written. And here are the 11 incidences of paying out $110 to the local utility. We'll probably re-index that for inflation here in about a month, but it's going along swimmingly. And the $330 has mushroomed up to almost $600. And the actual stocks themselves have gone up beyond my expectations. And I would call this so far a fairly interesting demonstration.
Mark, we have a question. Could you explain a line on that sheet that you just were showing? Could you explain the line, for example, that's the second SO line? It's an abbreviated line. It starts with a 0.66 in the price column.
Sure, that's the date is here. That's the actual dividend date. This is the quarterly dividend for Southern Company back in June of 2021, and then this.
Okay, I think you're already given the key word. Okay, so what you're doing is capturing dividends on the chart right here as positive cash, as positive value, right?
Right, and that basically goes right into the checkbook and maintains it. I will pay taxes on those too, also, by the way. So some people actually, what are you going to do about the taxes? Well, we'll pay it out of that $580 and do whatever we have to maintain that. But yeah, it's taxable dividend income, and the fact that it is now nearly $300 above where we started, even after making all 11 of those payments. And by the way, there's a couple good payments coming in the next month or so too, when the next round kicks in. So it's been kind of a fun demonstration. So
okay, so Mark, can I just, in other words, that entire column from the 0.66 that you circled right down that column there, those are all dividends for the various companies given on the date that's to the left, and times the number of shares that's to the right, and the dollar amount is just added to the checkbook then, right?
Yep.
Great.
And this number down here is what's actually in the checkbook. So we obviously have enough to make our next $110 payment. We also have another dividend or two coming in between now and then. So it's
okay. And here's one more question. FN is not one of the original 5 stocks. Is that just who you're paying it to?
Yeah, I can't remember why that's there. I actually noticed that and thought about taking it out. It's just the bank. It's basically a financial entry. That's all it is.
So it could be like Fidelity National. It could just be the name of the bank or the name of the company. Or okay, all right. So it's meaningless, in other words.
Oh, unless it's near and dear to my heart. Yeah. No, I actually thought about taking that out just to clarify that. And I will do that for the next time this rolls around, because we'll take a look at this from time to time. Then the other comment that came from half of the people that wrote to me is, the really cool thing about this is it points out you could do this with just about anything you can think of, vacation fund or whatever. You could actually build something like this, or, you could think of your entire retirement scenario in this sort of a situation. You're basically looking at the construction of a pension, only the difference is you or your surviving benefactors keep those assets up at the top. So there's some really compelling discussions that can go into something like this. But it's go ahead, Ken.
One more question, Mark. We have one of our audience people telling us that South Jersey Industries is going to be taken private. SJI, the fourth one down.
Oh, then we get to
So
do some shopping.
when that happens, then you will take the cash that comes from that privatization and buy another utility stock then?
I would say most likely, unless we can't find one that we can't warm up to, but that's
Okay, and in that case, you might split the money into 4 piles and put it into the 4 remaining then. But in other words, the cash would be used to reinforce the portfolio then, right?
absolutely.
Okay. I hope, folks, I'm not using your names most of the time, but I hope you're getting these answers to the questions as we ask them.
Well,
go on, Mark.
I think as you sit down over a cup of coffee and think through what's on display here, it's pretty powerful. I mean, I knew Mr. Janke, and I knew the senior Mr. Janke, and had met him, and he was extremely skeptical. And there are a few people in my life that are probably fit that description. Some of them stubborn, family trait. Something similar to this could be worth tinkering with, and it certainly shows the power of picking some quality stocks that are intended for the purpose that they're selected for, and the power of the dividend stream. And I'm not, you guys all know, I'm not a great fan of dividend stocks in general, but here I am.
Mark, we have another question. With the dividends that are coming from these, none of them are special dividends in any way, shape, or form. They're just good, solid, regular, qualified dividends, right?
Yeah, as far as I know, I could be blindsided by that a little bit, but I don't think so. The only one that's a little bit different was, I believe it's South Jersey Industries. Yeah, in fact, here's one. They didn't pay a dividend in the first quarter. They pay like a double dividend in the fourth quarter. So I probably need to check that and make sure that I got that right on here. But well, I think I did. This is a double dividend right here. So they paid just a second and a third, and then a double dividend in the fourth quarter. So that's the only one that was unusual. The others are they're like clockwork.
Okay.
And most of them are going up. Most of them are going up with the second quarter of this year.
Tremendous.
Anything else?
No, I'm keeping up with these questions here.
Okay. All right, just a quick reminder. I just love the aspect of Facebook that gives you like that time capsule thing. 5 years ago, actually 6 years ago, now Scott Rupp sent this one to me. I think it's still true today. Not going to do any more other than to mention that, you ask anybody like Warren Buffett or many of the successful investors that we learn so much from, they will all tell you that they do a lot of reading. And I know Ken does. And we just continue to encourage that. If you run into something really good that needs to be on that list of library books by us, let us know that too.
I'll tell you, Mark, that I do notice as I deal with older investors, they're much more aware of the source material for what they're reading. Younger investors, I find, are not as fussy about source material. And I think in the long run, that can be a detriment to your reading. I really think you have to understand that the most common source of information, which today is the internet, is full of great sources, but it's also full of sources which are out there and aren't necessarily factual the way you need to be factual when you're studying a company or an industry or something like that.
Yeah, and we are we belong to that club too. Trust but verify. The stuff that we bring to the audience, we make mistakes just like anybody, but we are constantly trying to strive for the foundations of everything that we go after. All right, here's just a quick reminder that did you get your copy of the book yet, Ken? Are you going to be in this one or are you going to take some vacation time?
I'm not sure that I'm going to take this one on, Mark. I have a number of vacations scheduled in the next 3 months, and going to enjoy them, I think. So not to say that reading this book wouldn't be enjoyable, but
Well, I've started. It looks pretty good, and I'll put you on DevCon full alert status if I think you really need to read this. And
okay, all right.
you know that if I tell you that, you're going to go back and read Google. What is it? The Life After Google again, aren't you?
I really like that book, Mark. I really did.
I want to go back and read it again too, I think. All right, so we're going to cover this one in a kind of a book club treatment, probably approximately a month out. So if people want to pick up the book, I do have my copy. I have delved into it a little bit. It looks worthy. As we have pointed out in the past, Mobison is influential in the running of the Morgan Stanley Counterpoint funds, and those are near the top of our rankings as a source of ideas. So again, like Ken was saying, you talk about going to the source material and then drilling down to try to understand where they're coming from. That's what we're talking about doing in this exercise. All right. Quick reminder that we archive all of these sessions, including bull sessions, roundtables, successful investing conferences, and intermittent educational topics on YouTube. You can go to YouTube, just search for Manifest Investing. You can search for Roundtable. You'll find this page. Please subscribe. We want to push that number up to over 1,000 so we can play with the gods at YouTube. And just wanted to point out that Sean Mace has been putting 60-second videos known as these shorts on the page also. And they're kind of fun. I look forward to expanding that and having some more fun with that and some of the other investing communities that we're working with that, dare I say it, Ken, sometimes the attention span of some of the younger people in the crowd is a little bit different than some of the other people that are here. And I'm trying to be really polite, but yeah, I used to work on a magazine where we would put out 5 or 6 page articles, and now they're basically driven to put maximum 1 page of text with lots of pictures. I mean, times have changed. And that's only the second or third slightly political or judgmental topic I'll make today. All right. And then, of course, we'll just close with a quick reminder that the April Roundtable is coming up 3 weeks from today. And we are going to do a special edition with the St. Louis volunteers participating from their community down there, specifically Candace Baker, longtime veteran in the education and investment efforts in the St. Louis zone, will be with us, presenting a stock with our traditional roundtable panel. The session before that, we're going to split it into 2 parts, start a little bit early. We're going to spend an entire session on honoring the workhorses of our portfolios. Anything you'd like to add to that, Ken, before we shut down?
Natalie and I are working on a reminder email to go out real quickly, and it'll all be spelled out, all the details, how you register, what the times are, everything. So when your normal reminder comes out, it should all be there. And just like normal, if you don't understand something, you can always drop an email to Natalie or to myself or to Mark. Any one of us can explain what the heck is going on. Mark, I do have a couple of questions to carry over after we finish here. Not very many, but a couple.
Okay, I'll go ahead and shut down. Thanks, everybody, for checking in with us. Good hunting out there. Len Douglas says that there's opportunities to be found in the NASDAQ today. So take care, everybody.
Mark.